Good morning, everybody. Welcome to the Flow Show. Finally got there to Fed Day. Finally got the announcement. Finally knew what Powell was up to, and got some big old moves to go alongside it. I hope you all traded safely. If you're up trading through that and the Bank of Japan, of course, which we'll talk about in a moment. Morning, K-Man.
Good morning, Ryan. Good morning, everybody. Yeah, the day after the day before. It's been a bit of a roller coaster.
Yeah, as we expected it to be. No, I'm not sure quite the roller coaster I was expecting, but we knew there was the potential for some big moves, and that we got. Right, let's get into it then and go over what's been going on. A little bit of news out of China. Chinese banks have raised mortgage rates for the first time since 2021. This comes amid, obviously, a big easing phase, rate cutting phase in China. So why have they decided to hike rates? It's only a small hike, up to 3.8% for first-time buyers from what was a record low of 3.05%. One of the reasons behind it is that questions are being asked about banks' margins and profitability, and so they're doing that to boost those margins and profits. And part of the reason for that is that for China to ease more, they want their banks to have more money, profits in the bank. So it's a bit of a, I wouldn't call it a doom loop, but a bit of an infinity circle, really. So need profits up, and hiking rates is one of the ways to do it, even though they're in an easing phase. I'll let you work out the economics of that one. Let's go over a bit of data first as well, because Kiwi data took an absolute pasting, and the Kiwi got pasted on the back of it as well. We got Q3 numbers now. These are first numbers for Q3. These are not revisions or anything like that. Quarter on quarter down a massive 1%. Okay, was it only expected to fall 0.2%? Year on year down 1.5%. We know the economy has been running with some minus numbers, but that is a very, very soggy number indeed. And that really gave Kiwi a whack on the head. And we'll look at that shortly, but not good news for New Zealand, those numbers there. Right, let's start with the good old Bank of Japan first. So after all the talk, they left rates unchanged, though there was one dissenter. One person voted for a hike and considered that economic activity and prices were developing in line with the bank's outlook, and the risks to prices had become more skewed to the upside. That was Naoki Tamura, who proposed that they hike, and that they hike by 25 basis points, which got outvoted by the other 8. The statement itself had said that the economy is recovering moderately, albeit with some weakness. And then there was this line, which I couldn't quite confirm whether it's new, in line with their thinking, or just a bit of a rehash of something they said previously. But they said inflation is likely to be at a level generally consistent with the BOJ's price target in the second half of our 3-year projection period through fiscal 2026. So that really is a dovish sounding line there, that it's still a long, long way away before they think that inflation will be at target. Before we get into what Ueda said, Kate, that line, have you seen it before?
I don't recall it in such wording, especially putting the timeline on, sticking the timeline onto it. But there was, yeah, I mean, all of those are always translations, right? Especially what what Ueda was saying as well in Parliament a couple of weeks ago. It is kind of what he said, that everything is going according to what they are projecting. But yeah, it's probably I don't recall to have a precise time on it. And like saying that it is going to be in the latter part of the 3-year plan. I don't recall that to have seen that in the statement. No.
No, and I look back over a couple of previous statements and minutes and whatnot, and I couldn't find similar. So that at least was in the statement, the big dovish comment there. We had Ueda obviously talking afterwards. He said that attention must be paid to the impact of financial and FX markets on Japan's economy and prices. He says the FX impact on prices has become more significant than in the past, as firms are more eager to raise wages and prices. Did say that they will keep adjusting the degree of easing if our economic price outlook is to be realised. So that was a repeat line. And then came all the caution. They need a little bit more info on wage trends. The uncertainties surround the US economic policies remain large. And this line, which pretty much sums everything up, it says the decision to keep rates was mainly based on the assessment of wage trends, uncertainties of overseas economies, and next US administration's policies. And then he got even more dovish. Not sure if we will have enough data by the next meeting, which is in January. And it's hard to say if the next outlook report and other data will be enough to represent one more notch. So not only did they not hike at this meeting and ruled it out pre-meeting, it looks like we're not even going to get another hike in January. And they're going to be waiting for the wages to come in March, which means the April meeting will be, I think, at least the first meeting where they may do something, but it's not looking good. I'm not sure what Mr. Ueda is up to, because he was striking a bit more of a bullish tone early in December, but now he seems to have gone the other way, and that they are getting scared of their own shadow, Kay.
I mean, it's crazy, Ryan. Really, it's crazy the way he changes. Everything was going all smoothly until end of November, beginning of December, and now all of a sudden, okay, there is some similarities with other central banks, as we will see. Um, Everybody seems to be cautious now and waiting to see what Trump is going to do, but it is crazy. We so often talk about windows of opportunity, especially for a central bank like the Bank of Japan. And if you look at the economic data, it's all there for them to continue to do. And then it all changed. As I was saying, I mean, Ueda didn't even talk that way, but it all changed with those two little messages that they sent out in the market, and now all of a sudden they are veering back to the cautious side. I just don't I don't understand why he is all of a sudden changing again. The one thing that, and we often repeat it, and I've been saying it so often, Bank of Japan's independency is a concept, right? It is not the same as other major central banks, and we had little proof of that yesterday again. But uh, it they just voted for a really big stimulus package, and does he want to kick the can down the road just to allow the government to fund their stimulus at lower rates? It could all be part of the strategy, but I am, well, not shocked, because we are traders and we always expect the unexpected. But I am really surprised, to be honest. The dovish tone that he struck, because he's at risk now. And imagine that inflation doesn't go up, and that economic data all of a sudden go like, well, just average, not like supportive enough. So then they are trapped until February, March. Imagine then that inflation is stuck to or below 2%. Are the employers going to be willing to raise another 5% wages? I'm not so sure.
Yeah,
So I
it's
mean,
difficult,
yeah,
and it's also the market's going to start thinking they can't trust a word he says. He
yeah,
leads policy one direction, a bit more bullish, a bit more hawkish,
yeah,
and the market gets on board, which is what they would want. The
yeah.
market being on board with a move, so that there's no shock when they get that move. and he's just pulled the rug out again. And so can we trust if we get opposite to what you're saying, if we get decent inflation numbers in the next month or so, and the market starts getting all hawkish again, and he starts talking bullishly, is the market going to go, well, you were like that last month and you didn't hike, so we're going to call you bluff a bit. I think they've gone from cautious to over cautious in my opinion.
Yeah. Oh yeah, it was never going to be guns blazing all guns blazing in Japan. We know that. But the thing is also, Ryan, imagine sitting at GPIF or Nippon Life or one of the Japanese whales and going like, well, hang on a minute. You told us that you're going to put the JGB yields at a reasonable price. We are waiting to get back into the Japanese markets and stuff. And now all of a sudden, you're not giving us the opportunity to step back into the JGB market at an opportune time. And they may be getting a little bit frustrated as well, meaning that if they can't bring their money home, they're probably going to put it at work even more elsewhere. Especially, and that's where everybody hangs its hat onto now, especially if the US manages to wrestle through stuff and we still get like pretty decent data, higher yields in the US. Where are the Japanese going to get returns on their money? Not in the JGB market, right?
Yeah, exactly. They're going to be looking elsewhere. And that's more potential selling for the yen. So they do like to make a rod for their own back, but we shall see what happens. But you're going to be very careful being short yen pairs at the moment, as we've been saying all week. Right, let's move on because we do have plenty of other central banks to get through as well. Riksbank, they cut their rate by 25 pips as expected. They're now at 2.5%. They said another cut is likely in the first half of 2025 if their outlook is realised, but future decisions will be carefully evaluated and a more gradual approach is warranted. So this is a bank that's getting rates maybe down to the sort of neutral rate that a lot of banks are looking at, 2%, 2.5%, 3%. So they're there now, hence why they're starting to put their foot on the brake, a lot like the Bank of Canada is as well. Norges Bank, they held at 450 as expected. There was a bit of a language change, a bit of timeline clarification, shall we say, in the statement. Their price statements had indicated they would, start to cut rates in Q1 2025. Now they've now put a date on that. They say the policy rate will most likely be reduced in March 2025. So there's clear forward guidance for you. No rate cuts until March.
I like Norges Bank.
Yeah.
I like Norges Bank in the way they communicate. They at least they are pretty clear all the time in what they plan to do. We also had this piece out earlier saying that they will likely buy some Norwegian kroner to pay back to the government. Put even a timeline on it. How they were going to do. I kind of like their style of communication at the Norges Bank.
Yeah, I do and I don't. As much as we talk about the BOJ and they're being all over the shop, that creates the volatility that we use to trade. When you're in Norges Bank and you're saying what they're going to be doing in March, that pretty much rules out any volatility between now and March. It's from one side, it's good to get clarity. From the trading standpoint, I'd rather it be a mess all the time.
Okay, you've got an argument there, but I think if they are clear communicators like they are, it's still Norwegian kroner is still volatile enough, right? Do you have any plans, by the way, after seeing or hearing those Scandinavian central banks? Because I've been having like loads of difficulties to really see clarity in either one of them. And have you got any plans to trade anything? To me, I mean, somewhere Noki Stoki, for instance, the two one against the other it's not at a level where it should, in theory, be. But I'm really having like a lot of difficulties to get myself over to trading it.
Yeah, I'll have to look at a different chart because that one's
that one's a bit wonky.
Yeah, I mean, nothing in knocky stocky, no. But I mean, there was some decent levels popping up in some of the others. You know, we
Fine.
were bouncing off this 103, 104 area, 110304 area, bit of support. But I think unless the only reason I play it is maybe a bit more dollar buying, taking up to that high there, 1124s, something like that, or a decent dip down towards sort of this area, this zone down here. But doubtful I'll touch anything before or this side of the new year anyway. But
Yeah.
and
Yeah, and I also
not
think it's worth in Scandies, like looking at the longer term moves because they tend to correct, but reversals don't happen your every month or so. Okay, you've got like up and downs, but look at that dollar Noki even since 2021. It's a
yeah.
pretty steady, if you're a longer term trader, it's a pretty steady move higher with the usual corrections when what a market usually has. But Norwegian kroner has been weak, and now we are through some decent levels there as well. I think any setbacks, and it's also not really been helped by anything in the energy markets because that's a big part of their economy, obviously. Um, it's not been helped. So yeah, I think still a bit at risk that that Norwegian kroner.
Yeah, I mean, this is looking like a decent break if it can hold. I mean, obviously it's come amid the Fed news, so you got to take it with a pinch of salt. But it's trying to hold this break, and there's a bit of open sky up
Mm.
to the next possible level for this one. So yeah, and we even just it's coming a little bit. We're even starting to get a hold against the break point, and if that maintains, then there's potentially further upside for it. But yeah, me, I prefer to sit where I'm not looking at these all day, every day. I prefer to look for the wider edges, the bigger levels, and take it from there. Right, let's get back to His Majesty over at the Fed. They cut by 25 pips to the 4.25450 range. There was one dissenter. Cleveland Fed's Hamak wanted to keep rates on hold. There was a shift in the dots. They now show a median of 50 pips of cuts for 2025 versus 75 pips in the last report. Four Fed heads have their dots at 25 pips or less. The longer run median rises to 3% from 2.9%. And as expected for 2025, there was a bit of squishing of the dots all coming around that median area. So more hawkish or less dovish than the market was expecting on all that initial stuff. Powell didn't really seem to change his tune an awful lot. Didn't really throw anything up to push back. Says the economy is strong overall. The labour market remains solid. We have been moving toward a more neutral setting, so we can be cautious going forward. It says they're significantly closer to neutral, but still restrictive. They're close, and getting closer to a neutral rate is another reason to be cautious. Now that was interesting because he was selling this or trying to sell this pause as not because they're worried about data, although he did touch on that a little later after that, but that because they have cut by 100 pips, they have moved closer to neutral, and that's a reason to start pausing, irrespective that they've got rates still in the above 4%. Now that could be an indication that the Fed are seeing maybe a higher neutral rate than a lot of people expect if they think they're getting markedly closer to it. So we could be maybe looking at something probably top end 3.5% of a potential neutral rate, if not higher, which would be higher than a lot of people think. Anyway, he then went on to say reducing policy restraint too slowly could unduly weaken the economy and employment. He says today was a closer call, but it was the right call. Then speaking about inflation, says we see risks and uncertainty around inflation as higher, and higher inflation is probably the biggest factor for new projections. So as we thought coming into the Fed. Those inflation readings are getting them a little bit worried. Where's the line for significant progress now? He says core inflation coming down to 2.5% next year. Core inflation's currently running 3.2 to 3.5%, so it's got some way to go. On the jobs market, he says market is cooler by so many measures now, but it's not cooling in a way that raises concerns. And adding on to that PCE note that he made there, he said, because we've got PCE on Friday, he said PCE probably rose 2.5% in the year ending November, 12 months ending November. Core prices probably rose 2.8% in November. So he's taken the sting out of Friday's reports by giving us the number. He was asked about a hike. He said they don't rule anything in or out, but a rate hike next year doesn't appear to be the likely outcome. I don't think it will be long if the data continues as it is before we do start seeing the first market murmurings of pricing in a hike. I'll have to do another pendulum gif, no doubt. Okay, Mr. Powell. Fed overall more hawkish than expected, but did you see anything in the comments that warrant anything more?
Yeah, you're spot on. The hawkish side of the hawkish expectations, that is for sure. Especially Hamak adding a little bit on top. So that spooked the markets. Powell tried very hard to walk either side of the aisle, but still stressing that everything is going very well. Where, of course, announcing also a pause, well, set the wheels in motion on the equity markets this time as well. And people needing to rethink what is possible. And that's where all those central banks and even at the Fed, they now seem to be in watch the show mode for when Trump will be taking the seat. And yesterday was rather than saying like we're pausing due to economic data. That's the official line. Obviously, they have to. He cannot say in words, we are waiting until we see what Trump is going to do. Not being the Fed, but I mean, other central banks have said as much. Go back to the Bank of Japan. Go back to Riksbank, and perhaps we are even going to see it on the Bank of England coming. This kind of comment. So I think they are now in a wait and see mode to see if they need to react to anything that's going to happen after Trump's inauguration, and especially, I would say, watch what the Doge clique is going to do under Musk's leadership. And I think they all want to wait now. So cautious is the new confident, and yeah, I guess we'll have to trade around that as well now, Ryan.
Yeah, and yeah, exactly that. My macro view is on pause now until the new year, because like everyone else, we're going to need to see what Mr. Trump does.
Yeah.
So you can make certain plans about next year, but yeah, we've got to wait for that like everyone else. That doesn't mean we won't get trades in the meantime. And as I've been saying, we are over the Fed hump now, and it's a big hump to get over. We are in end of year mode now. Okay, yes, we've got the Bank of England to come and whatever bits and pieces, but the market will be taking today to assess what's come from the Fed and everyone else, and then we're in that period where anything can happen. So be careful. Okay, you're looking at prices to go certain directions. Don't be surprised if they go in the opposite direction against the grain of what's been happening, trends or whatever. Okay, it may not happen. Okay, we should look at that side of things too. We may get a very quiet year end, but we are here to make sure we know the risks to our trading. Okay, and that's what we have to pay attention to. So if nothing happens, fine, we react to that. If something does happen, you won't be surprised. Okay, because we've had some big moves and some big recoveries already. Right, let's well, unless there's any other headlines or anything, Kay, we'll move on to the charts, I think.
Move on, move on, move on. I vote to move on.
So let's have a look at good old dollar yen. I'm just going to do my usual wide look here, try and keep it a bit clean because I find it's just a bit easier to read and find a bit of clarity in the text if you do that. So levels, said 157 was the next level above here. We've had a little tap of it, 157. What we got to 14 so far before pulling back below. So we've had little breaks, prior breaks through, but we've also had a lot of holds around here as well. So when you hit these big levels, these are the ones you keep an eye on. If we get above here, then it's going to be all about the 160 and this 160, 190s highs, these prior big highs that we've seen there. I don't see any reason why we don't go and have a look at this based on where we are now with the fundamentals. But again, if I see year-end selling in this pair that takes it down a big chunk, I'm going to be thinking very, very carefully as to whether that's a bit of a gift to get into some longs. But I most definitely won't be playing the short side on this one. Kay, do you think this is going to get? I mean, we haven't heard anything so far. Do you think this is going to get the MOF squawking again?
Potentially. I guess they will be watching other currencies as well. But they probably, well, they had, they will likely have had their alarm clocks go off during Ueda's press conference. Will they get there? I don't know. And also, you were talking about the year-end flows. There is still that potential that we see the natural way coming. And Mike was asking before what happened yesterday, there was, in my book at least, a relatively clear signal to sell dollars versus a good few currencies. But I would say especially stuff like cable or perhaps even Swiss franc or so, especially those where the equity markets have underperformed. But then yesterday, US markets also got like a 3-4% knock on the head. So some of these year-end flows may have been watered down. So that is one thing I would like to say about this. Now, back to the yen. Intervention risk, perhaps not before year-end. Unless we see an absolute explosion of the dollar yen, right, and go straight back to those all-time highs. And you know what? I mean, in empty Christmas markets, we have seen stupid things happening. Remember last year where dollar Swiss lost 5 big figures in a pretty short period of time. So I'm not going to rule anything out right now. It's clear that there is absolutely no reason to buy yen, as we've already said many times. So I'm with you there, Ryan. Any setback, and if it would come over year-end flows, any setback to levels that I would like, and I'm thinking specifically about somewhere between 154.5 and 152 on the white. They would be seen as a gift, I think, to get some longs on board again.
Yeah, very much so. And just to add to that for Mike, we've had one piece out from Barclays on year-end stuff. They're a bit neutral on what they expect from the dollar. They've got neutral signals, so nothing big they see for that. But people who are in our chat room will find all the month-end stuff going in there from the banks and whatnot. So make sure you're in the chat room. Check out the newsroom there. Where do we go next? Euro dollar. Again, I'm going to go on a bit of a wide one. This 103, 40, 50 area, whatever you want to call it. Okay. This is where we came down in November, hit that low, bounced. We've come down there again on the Fed and bounced. That has made it a significant level. We've had a lot of action previously, as you can see, against this area. So it's not an insignificant level, this one. I gave it a little go last night, 103.50, because I thought enough's enough. We hit the big level. We're not getting through it. So I've dipped into some small longs, which I've been slicing and dicing already. Coming into the shorter term, what do we need to do now? We need to get back above 104.50, which is that area there, which marks the lower end of the range that we've been playing up towards the 106 area. So firstly, we need to hold 104. That's the first test. Second, get it back above 104.50. If we can't do either, then it's going to keep these lows in the crosshairs, and then there's the potential for further downside. Again, given the fundamentals, year-end flows, I'm more likely to be a rally seller if I see a decent rip, and I'm not talking a 50 pip, something like that, but if we see a quick move up 200-300 pips, now up towards 108, something like that, and it's coming on nothing at all, then that's going to tempt me in. That's really all I'm going to be looking to trade going into year end. Otherwise, I'm going to be keeping the books fairly clear. My Aussie Kiwi, that took a whack over that data last night from New Zealand, all the way up to nearly 1080. I was noting this, that we were in a bit of a downtrend, a second phase downtrend. Now we're in another phase uptrend, which I need to keep an eye on. This being a bit of a data move, and the fact it's washed out fairly quickly might mark it as a bit of a temporary move, but we are making higher lows. So this one is grinding up again. So I might be waiting a bit longer to get some decent money out of this one. If I do see a move back up here, though, towards these highs, I'll start adding back to my short position that I've been slicing and dicing on the way down.
Yeah, on this one, I'm actually thinking that on that initial move, having been such a miss on those Kiwi data, it's not. I'm not overly impressed because it does not really hold the highs. Yeah, should have held around 110.5 in my opinion there, Ryan, and then move gradually up. We're already back below. I'm getting a bit of UK third quarter GDP vibes with this one. You recall the sterling dollar whack, and it lasted about a day, and then we gradually got back into a better sterling mood. I'm wondering if Kiwi couldn't do a bit of the same one.
Yeah, no, it's quite possible. I think a lot of this move is also the speed issue, that we talk about with euro sterling, the difference between Cable and the euro. We got Aussie, which pretty much hit the 62 on the head, but it looked really shit last night coming through that level there, which is one I thought we might at least get a little bit of a pause at. Let me come out a bit wider. This traffic zone here, but we just went straight through it. And I think this is going to be a consideration on the way back up. One thing I note about levels, if you see a level carved through over a big event, big news or whatever, it doesn't mean you ignore it if we come back there. So this will be a test. If we come back here and just go straight through it again, then I'll dismiss it as a level. But if we get up here, 62, 70, 80 and find resistance, then that's going to keep this bearish movement going. I mean, that's a big spike down, but it's the path of least resistance at the moment. So we might have just let off some pressure in this move. So I wouldn't be surprised if we climb back up. Maybe everyone who's been short up from 69 or wherever end of year want to book some profits. So I wouldn't be surprised if we see a rally. But then into next year, who knows? Kiwi, that got even more hosed, and there's been a definite bit of a black hole below here. I don't know where this one's going, but it's looking very, very ugly for the Kiwi at the moment. We could be heading down to these lows, 55s, something like that. You got any view on the Kiwi, mate?
Well, that's what I was saying just before, looking at the Aussie Kiwi, looking at the Kiwi dollar. We got absolutely, it got trashed there. but it's showing signs of wanting to come back, To me, yeah, 55.5 is your next big level. But of course, I mean, the harm has been done on the FOMC. So I think we may see some retracement activity, but I view it as kind of a retracement instead of like changing completely direction. Um, we're trading around 50, 56, 60 on the Kiwi. Get back into the 57s. Yeah, it is possible, but there's going to be big hurdles coming, and again, we cannot rule out anything over the year end, of course. And I'm kind of I kind of agree with Angela there on playing some of these bounces. I'm not a huge fan of trading seasonals, but I still can't unsee what we did last year at the end of the year when we were talking about is get over the central bank hump. We've got another one coming, by the way, in an hour. Get over the central bank hump, and then perhaps those year-end flows can start in all earnest. But then, um, if those 3.5% drops wouldn't have happened in the US equities, I would feel extremely confident being short dollars somewhere. But I'm a little less less confident right now. But I do think there is a fair possibility that um, there are. Oh, I mean the FX funds, FX neutral funds go to market, and we cannot rule out anything, of course. But there's going to be big hurdles on the way back up. And just to complement what you were saying, Ryan, and on the euro dollar, for instance, if we would see those kind of year-end flows starting to develop, my personal view is that flows or no flows, there's going to be a lot of people waiting at 106 if we get ever up there again,
Yeah,
a
yeah,
lot.
exactly.
I think those people waiting there, they may just absorb whatever has to be done on year-end flows. And I really think that's a very fair possibility.
Yeah, and again, I wouldn't rule it out either.
Yeah,
People
yeah,
who
absolutely.
a short market going into year end, I would not be surprised to see a bounce. So I'm going to see if I can hold these longs for a bit, but see what happens, and take every day as it comes. Every day as it comes. Right, quick couple of more, and then I'll pass it over to the Cayman. Dollar China, that's up as well. Bit of Fed in there. Two, making a new high. I'm not going to touch this for now. I was looking at maybe doing something, but I'm not. I just don't see this as the right moment to try fighting this trend. I can see much more happening in the new year as well. So I'm going to leave this alone. Again, as I mentioned to Dale yesterday, if I see a decent enough dip that looks like it's going against fundamentals, then I might even look the other way. So I'm not going to marry a strategy any which way, shape, or form. Euro sterling's going to be interesting going into the Bank of England, and we've obviously got that. I
Um,
don't think we need to say too much on our expectations. They're going to hold, and we just need to know what line they're going to take. Are they going to be worried about inflation being sticky, or are they going to be worried about growth being weaker? And that's what they do with policy. But this one might be getting my test of the 82 level, mate. I know you got some thoughts on that as well.
I do. Dump. Well, I mean, as I was saying while you're on there, it is a fact that Q3 GDP is a bit weaker, and we are never safe of Bailey commenting on that one. By the way, it's not a projections or I don't know how they call it at the BOE meeting.
No, no,
But we always have Bailey talking on a radio here and there
yeah,
after any of the meetings, so we can still hear from him well after they have come up with the statement. I do think that on the rest of the data though, and even some, I just included, a bit of interest rate differentials. Market also screwing back a little on the expectations for next year.
yeah,
It could be, and I really think that Looking at the what the equities did over this year as well, FTSE really has been an underperformer. I still expect sterling to be one of the currencies that is doing pretty well into year end. And to me, the cleanest for now expression would still be to be short euro sterling. Obviously, we need to always respect the levels because, as Ryan already said, you never ever know on the year end flow. So imagine that all of a sudden there's a shortage of euros in there and euro sterling could fly a big figure out of nowhere as well. So that's why in our usual trading style, I've already taken some off as well, but I keep enough on short euro sterling to potentially see at least a decent test of that 82, the figure there.
Yeah, exactly. Yeah, no, I got put out my short the other day
Yeah, me
when we had
too.
that break above 83, and I didn't want to put any more on, but yeah, I'm interested in giving this 82 a tap for a first test. It's a big enough to we shall see. I won't be giving it hundreds of pips and stop loss. I can tell you that for nothing.
Watch the clock, huh?
Yeah, watch the clock and see what happens. See what happens. Right, let me bounce it over to you, mate.
Yeah, just a few quick ones because there's been a few questions there. Oh, why do I do that? Oh, come on. It's is it Friday already? Because I'm clicking wrong buttons.
I wish
Um,
it was.
cable, we broke that 126 figure 10 in sympathy with all the rest of the dollars last night. But look at this one here. This is a bit of a trend line that has been respected over time. Um, and that comes in around 125.30-ish. And then you have your 124.80, 85.90 right below the prior low. Those are levels if the if the Bank of England would disappoint, um, could be tested if the rest of the dollars are gaining a bit tone again later on in the day. But our assumption is for it to be, no, don't call it hawkish or dovish, I would say on everything. But sticky inflation is probably going to keep them on hold, and keeping on hold could already be enough, at 4.75% to keep the sterling relatively big. So in the cable, also note that we stopped on a 23.6 here of the revival that we had earlier. On the cable, I think for as long as we're above here, I did buy it yesterday. Nice purchase as well, Ryan, on the euro dollar. And I did buy it yesterday just around here somewhere. So I've already taken a good few off because we are back on this 126, 60, 70. And that's been a traffic zone of late. So respect that level coming out of the Bank of England as well. If it flies through, then we are going to have to look again at the 127s here. Figure 20, and then my bigger line here is 127.35. If that would go back through, then I think there is still that potential alive for a late rally, global rally in sterling. There's one door that I was in and I let it go because I mean, if you look at the sterling, sterling is doing pretty well against everything. But then you look at this sterling Swiss, we're broken up, retested, and then holding, but we are just holding. And I, I really I really don't like it. So on this last little spike this morning here, I just let it go because Swiss franc is a strange one. Yeah, we are already back below the Euro Swiss, and remember what I told you: Euro Swiss is the is a very big, if not the barometer to measure Swiss strength. Okay, and it's coming down. It can't hold it. Of course, the euro is weak overall, but I mean, it, for the Swiss to weaken, this one, to me at least, needs to hold up as well, and it's not. So, Swiss has again been one of the beneficiaries, if not the only one in the FX world, beneficiaries of the risk-off scenario that we saw elsewhere. Risk-off meaning higher yields, lower stock market, has caused a risk of move yesterday, and the Swiss is the one that is really taking everything in it for it to when it comes to risk. I mean, gold was dumping, the Swiss gold correlation completely out of the window. Just don't even look at it right now because it's not following it at all. Okay, for those who are watching correlations, that one is really out of the window right now. So I'm very reluctant to hold Swiss franc, and I'm also still a little worried that we may see a last move into year end as well. So I mean that's the reason why, even though I'm still pretty bullish on sterling as a currency, but that's why I just let that one go, just because of the Swiss side of things. Gold, we did come down and very rapidly on the FOMC again. I said, like, be careful about 2630s moving down. We did even went quickly below the support trend line and my red line as well. So, but this looks to have been a very clear stop run here. Okay. I did go out of my gold around, yeah, when 2630s started to break, informed in the trades room, of course, out of my last bit. But then seeing this kind of move, I just started to shyly buy it again. And that brings me to what Ali was asking. I don't understand your 2026, your 2626 here, Ali. I don't see anything at all around this level. To me, it's still in the 2630s. If we get back above 3035, it's probably going to go. As Angela says, seasonals are, but I mean, I'm not a huge fan of seasonals myself. But watch what's happening here are in the 2630s, and then what would happen here? The Americans can come in and buy dollars again. Okay, that may be the thing that they do when they walk in. So really keep in mind that there could be a retest of 26, 20, 25.90, but and I'd love to see it actually. But if it would hold again, then that's going to comfort me to perhaps buy a little bit more. Silver, slightly different picture because we dropped through the box, we dropped through the trend line, and now this box is starting to act as a bit of a resistance. Yeah, I did add a little bit again to my very long-term position. This is not something for the intraday, but my very long-term position, and I take into account that there's a possibility that we are going to go back into the 28s. If really the dollar gets a lift at the start of the year into Trump's inauguration, we may even see 26. But if I see 26, that I'm really going to get my butcher's gloves out of the drawer and really buy with both hands over there. And what else am I looking at today? There's not much else I'm actually looking at today, to be honest. Ryan already covered the Kiwi, the Euro dollar. That's all done. Yeah, the only one is this one still. Sterling CAD is still going. Oh, okay, now it's coming back a little bit. I think it's all pre-Bank of England wishy-washy of positions, and the dollar CAD is coming down quite rapidly from the highs, but keep an eye on what's happening around 181.5. If we get back down there, we're about 35 points away from the break level there. So those doing intraday, it could be that we get a bit of a retest pre-Bank of England and then see what happens post Bank of England with this one. Okay, and Ryan, I think we have taken enough of our good people's time.
Thank you, mate. I will go back quickly because I did want to have a look at S&P, and I know Zhao wanted to have a look at that as well. If we get a quick return back up here, I think we're going through 61. Personally, I did have some buy stops running. I'm going to keep those in play. Levels wise, it's all short-term stuff still at the moment. We've had this big dip, obviously. We had this level here around 58, 70s. We're back above. If we hold that, that'll give it a bit of a support base to then maybe get back some of these gains. You've got to look at the long term though. Okay, we know what the long term picture's like. It's been up and up and up and up and up, and at the moment this just looks like a minor pullback. Okay, despite the big news. So we've come through rate hikes, rate cuts, inflation at 10%, inflation at 0, all through that, and this has done nothing but go up, and I don't see any real reason to change. So the bears are going to be out in force. This is the top. This is the end. It's going to 4,000, blah, 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 the usual rubbish. Until we start breaking some decent levels, then all-time highs remain in play. So I'm not tempted to buy a dip. That might be the sensible option. Again, that year-end stuff is having an influence on my decision for that. But if we do get a strong rally over the next couple of sessions, then maybe we are going on to those highs up there. But yeah, watch your levels. Big level is down here, 56.5. That's your main super level down into these fibs as well. So if we do keep going down, that'll be your level to look for maybe dip buying. Otherwise, you can always try some little bits here and there, tight stops, see if you can nick some pips. Right, on that note, stay safe for the BOE and what they have to offer, and then we will pick it up tomorrow for the last flow show of 2024. Thank you very much for coming today, and don't forget Christmas jumpers tomorrow, and we'll see you tomorrow. Thanks, everyone.